Hello friends, this is Rajat from Finogent, and as we know that the polycap has fallen sharply after there has been what do we say the income tax raid on the polycab industry across 22 locations across India. So therefore, in this short presentation, we will just see while there had been an IT raid, what is there in store for polycab, what its numbers says. In case of the polycab, there has been unaccounted company sales of around 1,000 crore, and there has been unaccounted cash payments of around 400 crore. Non-genuine expenses have been there, and therefore 25 bank lockers has been put under restraint. Now, once this news was out, and we have come to know that the polycab fall drastically down. So from the high of, say, for example, in the mid of or the end of the December at 5,727.70, it fell to around 3,801.95 rupees. So therefore, there had been drastic fall in polycab. So if we see here, this line is nothing but 200-day moving average. And now we are today on 17th of January 2024. Okay, and here we are saying it has already now touched the 200-day moving average. So we know that the 200-day moving average is being approached. Now the point is, the only exception to this would be if in case their accounts have not been flushed. If the accounts have not been flushed, the fundamental analysis might give us a different picture. So here, if we see that, we are looking at the latest operating revenue. So what does the operating revenue means? Operating revenue means through the operations, like it has a main operations of making cables. So how much of revenue it makes through its operating activities, and not through by, say, if they are selling off their plant or they are selling off their machinery, that would also get added to the net profit. So therefore, for us to understand the company in a much better way, we have to see that how much revenue company makes through their operations, regular operations. So therefore, if we see here, wires and cables have made around 88.62% of the revenue contribution, and the fast moving electrical goods have done around 8.84, and 2.53 are the others. Now this will take us to the another point. Now we know that it has a very good and big numbers as far as the 2023 numbers are concerned. When we look at the financial strength, it is still ranked at around 9 out of 10. This is because its cash is 8.16 times the debt. So cash to debt ratio is this. So therefore, it is very well funded to take care of the interest obligations as any. Equity to asset ratio is around 0.73. Interest coverage, that means 25 times it is covering the interest. So it is cash surplus in that parlance. However, even the Petrovsky score has been good. Now, while we are analyzing this, we have to see that what has been the industry median and what has been the historical median of the company. So if we see that its cash to debt ratio is around 8.16, while the historical mean had been 3.98, industrial mean is around 1.17. So it is around 8.16 times of the industry mean. Similarly, if we look at the equity to asset ratio, while it is 0.55 for the industry, and here also more than 10 points, 13.11 is the median for the interest coverage, which is 25.87 times in case of what do we say, the polycap. So therefore, if we see that they are financially strong inherently, unless and until obviously the numbers are not fudged and there has not been some dilly-dallying done in terms of the financials. If we look at the numbers, fundamentally they stand strong. This brings us to the next point. Where do they stand on the profitability rank? If we look at the profitability rank, their operating margin is 12.70. While its operating margin is around 13%, industry median is around 6.8. So they are normally operating at double the efficiency at which the average industry is performing. Net margin is around 10, which is again double of what the industry margin is. Return on equity is 24.7 times the industry margin. Return on assets is around 18, which is again around 6 times the return on assets of the industry. So ROC through Joel Greenblatt method, if we see that, again it comes 13.46. For the industry, it is way about to 46.40 as far as the POLYCAB is concerned. Now, we have seen in the past two slides, as far as financial strength is concerned, it is good. From the profitability point of view, it is good. And from the growth point of view, are we able to see the revenue growth sustainably and how it had been in the recent past and averaged over the 5-year period. So here, if we see the revenue growth for the 5-year has been an average of 13.7, while the last 1 year has been 19.9. So if we see that from the 5-year to 1 year period in the recent past, there has been surge in the revenue. Similarly, when we look at earnings before interest, tax, depreciation, amortization, that means when we are comparing two companies in which the depreciation and amortizations are different, and we need to compare them through the industries, through varying variables of the taxations and all, then it is at 15.8. 5 years back on an average, 5-year average data, and for per share basis now it is around 47 in the last 1 year. Operating income growth, how at what rate the operating income has actually grown, has been 3.3% averaged over 5 years, where it has been 48% for the last 1 year. EPS to non-recurring income growth. EPS happens in two ways. You can calculate EPS holistically, like diluted EPS, or you can have an EPS calculated on the per share basis without taking into consideration the non-recurring income. So if there is any income which is part of a non-recurring asset or non-recurring activity, so that has to be set aside, and that is a prudent way to calculate the earnings per share, which is around 20.1 in the averaged out, which again is a 51.8 in the last 1 year. Free cash flow growth, if we see that there has been a bit of the costing or the expenses done in the recent past, which have been further reduced. Book value growth has sustainably grown over the period in time. Now, while we look at the profitability and the growth, this brings us how the trend has been over the various quarters. So if we are looking at the quarterly, and we are looking from the September से लेके 2023 September तक, irrespective of how it has been, the revenue and the net income. Revenue growth percentage, if we are looking at, while it was 13.13 in September 2022, over the quarters, it has come up to 26.57. So revenue year on year growth has been good. Net income growth year on year has been good. The EPS has been good. If you see the free cash flow, there has been one of the negative cash flow. That is the reason why you were getting minus 88 in the last slide. If you look at the cash and cash equivalents, it has been good. Here it has been fallen, which again it has a bit restored. Total current assets have increased. The liabilities, obviously, with the growing operations, have increased, and the stockholders' equity, if we see that, that has grown. So the trend over the quarterly basis over the last 1 year, we have seen that on many parameters it has stood the ground. Now the next question is, among up to 5 competitors, where it where it stands. So here, if we look at POLYCAB, have been marked against Havels, CG Power Industry Solutions, Honeywell Automation, and KEI Industries. While we see that the biggest player here being the Havels at 10,829 crore, million dollar as the market capitalization. Now with this market capitalization, if we are looking at its score point, that is around 90. However, if you see the P ratio means how much extra money you are going to pay for 1 rupee of the profit. It stays at 37.23, which is cheapest among all the competitors. So that means for 1 rupee of the profit, you are actually paying 37.23 rupees. Where in case of Havels, you will be paying 76.16 rupees for the 1 rupee of the profit. So therefore, it makes it a relatively cheap buy when we consider all others. Now, if we consider based on the last multiple slides of financial strength, profitability rank, value rank, growth rank, and the momentum rank, if we see here, POLYCAB is among the top 3, and the momentum is the swing, how fast the trend is going in the technical indicators part. So apart from the technical indicators, if we see all the fundamental indicators, it is among the top 1, 2, or 3 performing across various parameters, which obviously shows that the company and its operations are really very strong, and they are there. There is a strength backing the stock, unless and that there is no just air in the you can say the hot air in the atmosphere. So it is actually the company which is having the strong numbers to back it up. So again, cash to debt ratio has been 8.6. So we have seen here that cash has increased over the period in time. Obviously here some expenses has happened. That is the reason why in last year it had gone down. Therefore the cash to debt ratio had improved in the last year. Then we come to weighted average cost of capital. Now, weighted average cost of capital simple means one thing. Their costing is at 11.85% interest rate, but they are generating the returns at the rate of 28.56. So that means 11, 22, it's more than double rate they are having a return on invested capital. So therefore, higher this, it is good. High is good. So therefore, we have seen from say 2020 and 21 and 23, there has been a sustainable increase in the what we say the ROI, see return on invested capital, while they have tried to maintain their weighted average cost of capital. This means that the cost has been maintained. The cost has been maintained while they have improved on the return on their capital invested. Again, debt to equity ratio is less than 1, so it has been maintained over the years. So they have not increased the debt allocation to it. It is not more leverage, so therefore the cost of debt in terms of leverage would not be there. So now this brings us to the financial strength of POLYCAB relative to many of the Indian and global companies as we see that. Again, financial strength, cash to debt ratio, equity to asset ratio, debt to equity ratio, interest coverage ratio, Petrosky, Altman, all these shares along with WACC, ROCC. So here if you see rank wise, it is always on the financially strong. Then we are looking at the cash to debt ratio. It has 8 times the cash. But if we say Havels for that matter, Havels is also having 8.74. It is also around 8 points this. Equity to asset ratio is 0.73. Here it is again 0.63. Its debt to equity ratio is rather lower than that of Havel's. Better positions. Interest coverage ratio, if we say that it covers its interest 25 times, it covers its interest 41 times. Any amount greater than 5 or 7 times as the ICR interest coverage ratio is considered to be good. Petrosky score 6 being average. Altman score 16.40 is again okay. And because of the recent swing in the market, Benish M score cannot be thought of being the correct interpretation of it, because it talks about the manipulation in the price, but it rather has not been a manipulation in the price, but the knee-jerk reaction of the IT rates that had swung the prices so fast and in such an aspect that this score has been affected. So if we see Havels here, Havels is having a weighted average cost of capital at 10% and return on capital at around 18%. So we can say 8% difference. Now here if we see that their costing is at 12% and they are at 28%. So it is more than 10%. So it's like 14-15% spread. So its spread is higher than what that Havels is doing. So therefore I can say that while the POLYCAB is just at 37 PE ratio is a cheaper stock, giving me a higher return on equity, as well as I would say that it's giving me better what we say that the spread between the WACC and the ROIC, it's much good a case. We are comparing POLYCAB and Havels here, and while there are many other players also, but we are only managing those who are into the top 1 and 10 categories. And that is how we are looking, because we want to compare it with one of the biggest competitors into the industry, so that we can see how much strength it has in its financial to support itself. So therefore, now this comes us into the comparative analysis of the profitability. So here we are looking at the Phenolax. Profitability wise, it is among the top 3, as we had already shown earlier. It has 12.7% of the operating margin. While Havels, if you see that, it is 8.28% of the operating margin. So operationally, it is more efficient than Havels. And if we see at the net margin, it is at 10.05%, where at the 6.69% is the Havels. So it is again, it is high at the net margin, it is high at the operating margin. Then we look at the return on equity. It is 24%, it is 17%. So therefore, it is again good at the return on equity as compared to Havels. Return on assets, how much has been the return on assets? It's 10.92, and here it is 19.7. So if we say that this is up, this is up, this is up, this is up, and in case of the Havels, they have been lagging in terms of their core numbers as we see it. So when you talk about the 3-year revenue growth, it is a 7.10. Its top line revenue growth has grown by around 21%. 3-year EBITDA growth had been 15.8, it had been 17.8. So that means while they are putting in the revenue, operationally they are not as efficient as POLYCAB. POLYCAB has operationally given much better return in terms of revenue generating through operations than Havels, while the revenue growth rate of Havels had been better. However, over the same 3 period, the EBITDA, that means if we remove the impact of the interest, tax, depreciation, and amortization, it is still 15.8, which is lower than 17.5, what is for POLYCAB. And if we see earnings per share, that too without NRI growth rate, it is 12.7% for Havels, while being around 17.4% for POLYCAB. This again shows that on the profitable perspective itself, also this is much better place than Havels. Now, if we come at the valuation aspect of it, and we are looking at this, we are having a P ratio. P ratio means how much costly a product is, how much cheaper or costlier you're going to buy it if you invest in the market. So it's 37.23. And if we see Havels, it is 76. Matlab, if you want to earn one single rupee on your investments, in Havels, you will be paying 76 rupees. But in POLYCAB, you will be paying only 36. That means half the price. To earn the same 1 rupee, you are paying half the price in POLYCAB than in Havels. And if we say price to book ratio, price of the stock is 8 times the book ratio, it is 13 times the book ratio. So again, it shows that it is highly priced, overvalued in that sense. Price to sales ratio is 3.74, it is 5. Again, lower, the better it is. We have then found the value of the what is the price to the intrinsic projected free cash flow, then discounted cash flow valuations, then price to the median price value, then price to Peter Lynch fair value. So these are the different ways in which you can value a stock. So whether it is overvalued or it is undervalued. So these are the different mechanisms. 1, 2, 3, 4, 5. These are the different 5 techniques by which you can see whether it is overvalued or the undervalued. So forward rate of return, if we are seeing that, we are looking at 18.55 here, where it is only 11.69 as far as the Havels goes. And if you're looking at the earnings yield, it is around 3.81, where 1.85 for Havels. So here, if we also see from the valuation point of view, POLYCAB still stands a good number and good competition to Havels even after this. So therefore, guys, the conclusion here is actually totally dependent upon how you are going to take this dip. So on a face of it, I can say that just like we had previous a couple of occasions where due to Maggie fiasco, the prices had come down for the Nestle, and for Maruti there had been a fire and a protest at the Manesar plant that got the price corrected substantially due to the knee-jerk reaction. And unless and until if the financials are not fudged, if books are clean, and only the tax evasion has been there and no inflationary numbers have been put, then there is no doubt the POLYCAB stands hands down. It stands hands down with the financial numbers to back it up. It has been more efficient in its operating activities. It has been good at its valuations. Its financial strength and profitability has been good. So while it is not an investment advice, but in case you think that okay, should we go into it? If I have been there, I might go partially. I might go at different levels. I might see that, okay, is it trading at 200-day moving average above or below? Or if it has just crossed 200-day moving average and things are improving, then I will go for it, because one of the most value buy for any stock is if the numbers and everything are good and it is crossing its 200-day moving average on the buy front. That means from bottom of the 200-day moving average to plus, it's crossing it upwards, then we can expect from 200-day moving average to 50-day moving average, we can still see a bull run. So POLYCAB, while being the stock worthy to be hold for the long term, these price points provide an exceptionally good opportunity for investors to take positions at much lesser a price, which otherwise they would have been doing 15 or 20 days back. While it is so, the investment has to be done as per your risk appetite. It is not the money game. Even if you are paying at this price thinking that we will have a bull run shortly, the duration of the money that you are putting it should be from the source which you know that you don't need for 5 years or 3 years for that matter. It is no get rich quick scheme. It is a serious business. So thank you so much, and take care of your risk profile and your financial goals before you invest anything, and do consult your financial advisor before you take a call, because every individual's financial aspirations, expectations and psychological bent of mind is totally different for it. Thank you so much. This is